All right, everybody, welcome back to another video here on Financial Friends. Today, we are going to discuss how to predict the stock market, and sorry to burst your bubble, but the reality is that you cannot. So before we get into the video, and before you click off of this video because you're upset, go ahead and hit that like button down below. Also hit subscribe. I think that if you watch this video out, if you were a little upset at me, you'll probably want to hit the like button and subscribe afterwards. You just got to give me a little bit of a time to explain what I mean by nobody knows what is going on. So we're going to run through a pretty quick scenario. We're going to dive into some very specific predictions that were made and then kind of wrap things up with why I don't believe you should be trying to predict what's going to happen day in and day out. So first things first, we're going to run this scenario where you try to predict every single day, what is the stock market going to do tomorrow? Where is the market going to be at the end of the day at 4 o'clock Eastern Standard Time every single day? You can see here I have the chart for the S&P 500, the top 500 largest companies within the United States, and you can try to predict every day what's going to happen, but the reality is that we've had 4, 5, 6, 7, 8, 9 green days over the last 30, and your odds are 50-50 every single morning when you wake up. It could either go up or it could go down. So if you try to make that prediction, which in this sample of roughly, say, 30 or so days, 9 of them were in the green. The issue with that is you cannot wake up every day and make this prediction and bet the house because it takes longer to generate profits once you have made a loss. You cannot consistently, day in and day out, wake up, bet the house, and move forward. Wake up, bet the house, and move forward because those losses, those days that do generate losses, and there will be sustained periods of loss over any time period. Doesn't matter if it's 30 years, 10 years, 5 minutes. There's going to be a period of loss within that time frame. Now, these losses are, as I already said, a little bit difficult to recover from. And the reason here is if you have a 5% loss, let's say on $100, your initial investment or the pot that you now have is down to 95. And so in order to get that 95 back to 100, you would need to see a gain of 5.3%, which is larger than your 5% loss and is much easier said than done. Now, if you lose 10%, that jumps to 11.1%. 15% jumps to 17.6% and continues to compound all the way up to if you manage to lose 95% of your funds, you would need to see a gain of 1,900% just to get back to square one. So Warren Buffett's rule of don't lose money is pretty relevant here, especially if you're trying to jump in and jump out repeatedly or make some form of a prediction at all. Making any form of timing decision and having to be handcuffed to that one time is not necessarily a good decision because, again, your odds are kind of poor. Yes, they're 50-50, but they're kind of poor. Now, let's go ahead and dive into a couple very specific examples of poor predictions and then talk about why time can heal some of these predictions. So what I have here is a prediction by Robert Zucaro. He says that the Dow Jones, or said rather, the Dow Jones would hit 30,000 points by 2008. Now, today, he's correct in 2022. But back then, in 2008, we saw the worst financial crisis since the Great Depression, and the Dow Jones plummeted 30%. So in a short time period, this gentleman was extremely wrong. Now, he had generated triple-digit returns about 10 years prior to this. Not a good move. Now, today, he's sitting pretty, but again, it's 2022, many years later. Now, the next prediction here was by Paul Krugman, who said that the internet will have no impact on investing in, quote, as the rate of technological change in computing slows, the number of jobs for IT specialists will decelerate, then actually turn down. 10 years from now, the phrase information economy will sound silly. Now, he was extremely wrong and continues to be extremely wrong today, but he didn't win a Nobel Peace Prize in 2008, so it seems that time healed. Now, This one, time did not heal. Whitney Tilson said that the Google IPO would be awful. And quote, "I believe that it is virtually certain that Google's stock will be highly disappointing to investors foolish enough to participate in its overhyped offering. You can hold me to that." Well, holding her to that statement, you could see that Alphabet is up 3,617.53% over that time frame. Now, time did not heal here. Now, what am I trying to prove to you? These were three people who made really, really bold predictions. If you're trying to make a prediction within the stock market, it is bold. And the reason it's bold is nobody actually knows what is going to happen. Yes, there are little inklings of speculation that you can make. There's some things going on in the current world, in the current economy, the current news cycle, whatever it might be, that might influence some form of a decision, but 9 times out of 10, if you know about it, so does everybody else, and those events are already priced in. So making bets or bold predictions within the stock market, like I see people on Twitter and other social platforms do every single day, does not make sense. Now, expanding upon this, of course, like I said, my point is nobody knows what's going to happen. Guessing does not help because if you lose, you're actually worse off than you were before. The actual logical thing to do in a situation like this is avoid guessing. Instead, get involved with investing and actually make a long-term bet, or not a bet, but instead an investment in a company over the course of 10, 20, 30 years. Now, you can use ETFs as we spoke about in previous videos. A link to those type of videos will be up above. But you can see here the probability of positive returns increase the longer you hold an investment. Now, we spoke about this 50-50 opportunity. You can see all the way down to about a 0-year holding period or less than 1 year, so maybe a couple of months, the odds of a positive return are 55%. Now, what that tells me is the 50-50 shot that we spoke about pretty much holds true. About 55% of the time, if you're holding an investment less than a year, you have odds between 50 to 65% of making money. But as you hold that investment longer, upwards of 11 to 12 years, your odds increase to nearly 95%. Actually, I'm sorry, nearly 100%, about 98% or so. So that tells me that making an investment and holding it long term, regardless of essentially what it is, holds good. Now, I'm not telling you to go make investments off of this. I am not telling you to go buy anything in particular, but what I am telling you is to think about the way that you think about the stock market. If you're trying to predict what its next move is going to be, you're playing a losing game. Instead, odds are in your favor if you pick companies based upon research, based upon historic research, based upon current and potential future events, and make sure that your investment in that business is not one that you then move off of the next day because some form of something happened out in the world, but instead you make a conscious decision to continue to make investments in that company over a 10+ year time frame, and the odds that you have to benefit from that investment are upwards of 90%. So, this YouTube channel is free. Make sure to hit subscribe on this YouTube channel if you enjoyed this video. Also, check out TikTok, Instagram, and Twitter. The handles are back behind me or on the screen now. Thank you very much for tuning into this video. As always, leave your thoughts and comments down below in that comment section. I do appreciate your conversation in the comments. And thank you very much for watching. I will see you all in the next one. Take care.